The Australian Financial Review.
Petrol prices are in the news again.
Millions of Australians are going to be paying more at the petrol pump from this week, with the temporary discount to fuel excise ending overnight.
The government's decision on the weekend not to extend the discount is already being felt at the Bowser.
Good evening. Fuel prices are climbing. Unleaded has shot past $2 a litre in some towns as the end of the excise relief kicks in.
The price rises may be tempered by news this week that a peace deal in the Iran war will be revived.
To the Middle East crisis now, and US President Donald Trump's top economic advisor says he thinks a deal between Washington and Iran on the Strait of Hormuz is imminent.
But it's hard to get too excited, given the on-again,
It's a great deal. It's a memorandum of understanding.
off-again negotiations.
We'll go right back to dropping bombs right smack in the middle of their head.
We were very close to a deal.
And even if a deal is reached, there's no guarantee it will last or end the chaos in the Strait of Hormuz. The oil price disruption isn't going anywhere.
This is probably what a major oil crisis actually looks like in the 21st century. It's going to be a kind of slow burn that's going to wash through the economy over time, and its effects will be incremental, but they will be significant, especially the inflationary effects.
Welcome to The Fin. I'm Lisa Murray. This week, senior resources writer Angela Macdonald-Smith and energy and climate reporter Ryan Cropp on the reasons we all stopped freaking out about the oil price and why that was premature. It's Thursday, August 6. Hi Ryan, hi Angela, thanks for coming back on the podcast.
Hi, Lisa.
Good to be here.
Angela, at the start of the Iran war, we were all bracing for one of the biggest oil price shocks in history. There were lots of headlines, lots of forecasts, but somewhere in the last 5 months, everyone stopped worrying so much. Why?
Yes, it's a pretty interesting situation considering those dire forecasts from quite respected analysts when this war broke out in late February. We heard forecasts then of $150, $200 a barrel of oil, or even higher. But the reality is Brent peaked at about $126. Mm-hmm. That's well below the 2008 all-time high. And more recently, prices have been trading below $100, below $90 even, despite the disruptions in the Strait of Hormuz lasting much longer than anticipated.
Mm-hmm.
Look, some people, initially were saying the effect of this would be worse than the disruption when the Ukraine war started in 2022 and the twin oil shocks of the 1970s. Back in the 1970s, oil prices quadrupled during that first shock and then more than doubled in the second oil shock later in the 70s. But there have been a few factors that have actually come into play here. Firstly, on the supply side, although the Strait of Hormuz closure takes about 20 million barrels a day of oil out of the market, so that's about 20% of global supply, there's still about 2 to 3 million barrels a day getting through in this dark fleet operation. And then there's another 4 to 5 million barrels a day getting out to global markets through alternative routes, such as through the Red Sea. And we've also seen an increase in oil exports from other countries. US, Canada, Norway, Brazil have all upped exports. And the easing of US sanctions against Venezuela earlier this year also allowed more exports to come from there. And then on the International Energy Agency initiative, we had a record 400 million barrels of strategic reserves released under that initiative.
And Australia was part of that.
Absolutely, yeah. And then several things on the demand side have also helped us just better balance the consumption of oil with what's actually available. The biggest factor here has been China, which dramatically cut back oil imports as it preferred to draw from its own huge stockpiles of oil, rather than buy even more at high prices. There's also been a pullback in consumption in some more price-sensitive countries, particularly in Asia, and then just generally softer demand from the aviation sector. It's all really meant that on the global market, this imbalance between supply and demand hasn't been nearly as stark as initially feared, and that's really taken some panic out of the market.
And Ryan, meanwhile, individual countries like Australia were marshalling their own response, and those had an impact as well.
The Australian government at the start of this crisis basically made a decision that they would pay anything to stop this becoming a major political issue. I mean, the biggest and most expensive response was a cut to the fuel excise, which is the tax you pay the government on every litre of petrol and diesel you buy at the service station. Now, that cut 32 cents a litre off the price of petrol and diesel, and that cost the government about $3 billion over 3 months. They also set up a mechanism that allows the government to underwrite purchases of fuel on international markets. So that gave big refiners like Ampol and Viva the ability to pick up cargoes even if the prices were uneconomic. So Australia was just picking up cargoes on the spot market, making sure we weren't going to run out. The government didn't put a precise figure on this one, but it could end up costing another several $1 billion.
Okay.
And then at the budget...
The Prime Minister has unveiled a $10 billion plan to boost our national fuel supplies.
They announced building up a new nationally owned supply of diesel and jet fuel, like a reserve stock. And the idea behind this was to raise our minimum stock levels to 50 days, up from around 29 days pre-crisis.
Okay.
And all of that, and particularly the fuel excise cut, has had the effect of basically neutering this as a first-order political issue. Everyone seems to have forgotten about it. Because, the one touch point for this at the petrol bowser, that has gone away. That has faded away as a problem. People have just stopped thinking about it. Now, that may change. This week, the fuel excise is coming back on. This issue may rear its head again.
Yeah, I think it's meant that everyone's got a bit of a distorted view about what's really happening, I think, because those government policies have actually been pretty effective. It's enabled everyone to continue pretty much as normal. A few months ago we were talking about people cancelling road trips.
The fuel crisis has forced 40% of us to change or cancel Easter plans.
Perhaps, having to buy fuel only on alternate days.
Everything from fuel rationing to COVID-style emphasis on essential services, that's on the table.
But that's just really disappeared totally from the conversation now.
It definitely feels a little bit like the early days of the COVID pandemic to me. When that event initially happened, there was kind of mass panic, apocalyptic sentiments, huge drama, government TV addresses. Everyone was quite worried. They had major kind of economic and physical shocks to the economy. And then it kind of settled a bit. People were kind of hoping that it would go away, but it just had this kind of long tail. And this feels very much like how this has played out.
The global energy crisis is beginning to bite in Australia.
You had big shocks at the petrol pump.
With hundreds of petrol stations out of at least one type of fuel.
You had Energy Minister Chris Bowen.
And our refineries are working full pelt.
Giving daily press conferences updating us on fuel reserves.
Victoria 51 without diesel, Queensland 49, South Australia...
had petrol stations running out of diesel. And then it's kind of faded away, but it's still happening there in the background, right? It's not the kind of thing that's going to go away overnight, it appears. The geopolitical situation in the Middle East appears unresolvable at the moment. And so by that kind of crude logic, there's every chance this flares up again. On Sunday, we saw the government basically let this fuel excise cut roll off.
Petrol prices will soar across the country this week.
Past $2 a litre from midnight tonight.
All of that tax relief has now come to an end.
Prices are coming back up. There are predictions that we're going to be paying around $2.20 a litre for petrol, $2.60 for diesel. And interestingly, actually on Saturday, Chris Bowen's weekly press conference, there were a few more questions than usual. I think this is coming back onto the agenda.
It is coming back on the agenda, but Ryan, just on the government measure to subsidise purchases of fuel, this might have worked a little too well. You reported this week that there are ships waiting offshore to unload some of that fuel because there's no storage.
That's right, Lisa. So the government's plan to subsidise fuel was always about bringing in additional supplies of petrol and diesel. So that's over and above what we would ordinarily import. So think of that as a kind of insurance policy against another major supply shock like the one we saw in March and April. But over the last 15 weeks, it's underwritten 19 shipments of additional fuel cargoes. And that's actually done what it was intended to do, which is to ease the panic and bring down prices. But it's also brought in a lot more fuel than Australia actually has the capacity to store at any one time. And we reported this week that one vessel has been anchored near Queensland's Sunshine Coast for several months, with at least some of the huge costs of those delays being picked up by the government. There's another vessel near Geelong, for example, that's been on the water for 86 days. So it looks on the surface like the government may have slightly overdone its response here and that taxpayers are picking up the price. But I guess from the government's perspective, they would argue that that's actually quite a small price to pay to ensure that our fuel supplies are really rock solid, and they'd actually rather have too much fuel than not enough. And so given the risk of fuel shortages is showing few signs of abating, they'll be thinking that was probably a pretty good bet.
But Angela, what else has changed? Why are we starting to see global markets on edge and some analysts even coming out and forecasting those big highs again of potentially $150 a barrel?
There's definitely been a bit of a tick up in nervousness, I think, in the market. People have really realised that the peace deal signed back in June really doesn't mean that much. I think it's important to mention here that the price everyone focuses on is actually the futures price of oil. That's a sort of speculative price. We all hear, in the nightly news about Brent crude oil rose to whatever, but that really is just the futures price. You've also got the physical market. And I think in that physical market, a lot of the traders and participants have really perhaps had a bit more of a realistic view about the impact of these ongoing disruptions and risks to supplies.
So the price we hear in the daily news updates is actually divorced from what's happening on the ground?
Yes, I think it can be. And then just in the last few weeks, we've seen these renewed Iranian attacks on tankers in the Strait of Hormuz and American strikes on Iran. We've also seen Yemen's Houthis seek to block the Saudi-linked shipments passing through the southern end of the Red Sea at the Bab el-Mandeb Strait. And that's forced some shipments instead to go northwards through the Suez Canal, despite the much lengthier sort of shipping timetables that involves.
So it's not just the Strait of Hormuz that's being affected, it's these alternative routes that helped to absorb some of the shock in the first place.
That's right. And then even at the end of last week, we saw that attack on a port in Egypt near the Suez Canal. And that's pretty worrying because it's the first strike on Egypt, and it also suggests that that waterway is also really vulnerable if this conflict escalates. At the same time, we've got the ongoing war between Russia and Ukraine, so increasing strikes by Ukraine over the past several months against oil processing capacity in Russia, and that's caused Moscow to extend restrictions on exports of petrol and diesel. This is all just dragged on. Clearly strategic fuel reserves that we spoke about earlier are just being worn down, and that's sort of reducing the protective buffers that we have in the market.
Yeah, it's so hard to predict because there's just so many things happening at once. This is no longer a purely Middle Eastern story, right? I spoke to someone in the government this week who's dealing with all of this, and they pointed as an example to the recent Ukrainian drone strikes on Russian oil refineries, which have led to a ban on Russian diesel exports and then put further pressure on global markets. In the May budget, the government actually provided a scenario in which oil prices peaked at $200 a barrel by September, which is roughly double where they are now. But under that scenario, that would lead to a peak headline inflation rate of 7.25%. These are not easy situations for the government to deal with, potentially, if this goes on, right? So I've been asking people for months, should we be worried? And the answer always just seems to be we're not really sure. With global crises like this one, there's always so much uncertainty, and it's not just about the Middle East. With markets stretched, a decision like that made in Ukraine can have material effects on what Australia's trading partners in Asia do with their crude and refined oil supplies. And that's not something entirely within Australia's control. We can't insulate ourselves from this forever. And it's something the government's having to manage week to week.
We're talking about why oil markets are once again on edge as the Iran war drags on. Ryan, as you say, Australia is managing this week by week. On Sunday, it opted not to extend the fuel excise discount, and petrol prices are a political hot potato. How worried is the government?
I think if you look at the way the government's responded to this crisis so far, it's pretty clear that if they can, they're not going to let petrol prices go to the moon, above $3 a litre, for example. I'd say if there was another emergency situation like we had at the start of the crisis, they wouldn't be shy to step back in with another cut to the excise, even if it's going to cost billions of dollars to the budget. I think the bigger risk at this point, though, is not so much at the Bowser, but in the broader economy. The inflationary impacts are already filtering through. Oil is in everything. It's in all these products that we import. It's an input cost into all kinds of products. Fertilisers for food, petrochemicals, diesel for transport. Those broader price pressures have obvious political implications when it comes to things like interest rates and housing, cost of living. But then again, it's not all downside for the government, I think. I mean, one positive impact, depending on which way you think, is that we've been doing all this fuel diplomacy with Asia, right? We supply a lot of gas to these Asian trading partners. They provide us with refined fuels, shoring up supplies. We could be on the cusp of a massive gas boom in Australia. Huge new investment boom as these countries turn to safer Australian gas, that they can't get from, say, Qatar, for example. So there's an opportunity. One of the other happy outcomes has been this huge surge in electric vehicle sales. Last month, almost 1 in every 4 cars sold was fully electric from just 7% 12 months ago. Like a massive change in buyer behaviour. And at the margins, that's going to have an impact eventually on our reliance on imported fuels. It's kind of one transformative outcome of the crisis, but, it remains to be seen how sustainable that is, of course.
I mean, already you're seeing the headlines, fuel excise cut, EV drivers don't care.
Exactly.
Angela, one of the issues that has come up in this debate over fuel security is sovereign capacity. Australia is down to its last 2 oil refineries and both are calling for more government support. Should the government subsidise domestic refining?
Well, it already is to a certain extent, but I think we're going to see that rise to a totally new level. Remember, we had 8 refineries in the early 2000s, but that's now down to just 2, operated by Ampol and Viva. So there's been a massive reduction in our ability to refine oil here. That means we're dependent on imports now for more than 80% of petrol and more than 90% of diesel, which is a fuel that's just critical for our economy for so many areas, defence, agriculture, mining, not to mention cars. And basically the reason for those closures was economic. Those plants were just really small, old and inefficient, and there have been so many big new refineries built in regional Asian markets in India, Singapore, Korea, huge plants with much better economies of scale. So the 2 refineries that are left here are really just hanging on a lifeline of this government support package. But that really only guarantees their operations for the next couple of years in any case. And so under discussion at the moment, we've got the second phase of the refinery fuel security package that should be finalised by the end of the year. And it looks as if it's going to mean a big increase in the actual support in order to try to keep those 2 remaining refineries going. It is quite odd because this push for more support is coming as profits from oil refining have soared with the disruption of oil flows through the Strait.
Yeah, we've seen some huge results.
I mean, last week we saw Viva flagging earnings for 6 months to June more than doubling, and Ampol's first half earnings are going to triple on some measures. But those 2 refiners say that much more certainty is needed on returns from refining in order for them to invest in the plants. So huge amounts are needed to maintain the plants, help them keep on running, and perhaps just adapt them a little bit better for the future. So perhaps orient them more towards diesel rather than petrol, for example. I mean, a closure of Ampol's Lytton refinery in Brisbane or Viva's Geelong plant would put Australia really at the mercy of overseas suppliers in what's become a tremendously volatile and tight global market for petrol, diesel and aviation fuel. That really gives the refineries a pretty strong bargaining position in these discussions with government. Last week, we also heard this talk about a potential new refinery in Western Australia. It would be the first refinery built here in 6 decades. But as to how realistic that is, I'm not sure. It would take years to build, and estimates of how much it would cost have ranged from about $7 billion to as much as $15 billion. Australia's a really high-cost destination to build big plants like this, and the same reasons are there why those refineries closed in terms of just the size of the Australian market, etc. So I think it looks really difficult.
And I think that announcement last week about the feasibility study for the new oil refinery in WA, it does go a bit to the domestic politics of all of this. The opposition at a federal level have been waging a bit of a culture war over energy and the fuel crisis. They've been leaning heavily into this kind of Trump-style drill, baby, drill type stance. Why aren't we leaning into our fossil fuel advantage? And so I think the government has, in its response, tried to ward off this sense that they're just trying to end fossil fuels and lean right into renewables and we're all about this. Whether or not this oil refinery is going to get built is another question, but they're clearly using this as a bit of a wedge to be like, look, we are leaning into this. Like, we're not just focusing on wind farms, right? We're going to build an oil refinery if we need to.
So a final question for both of you. Do you think that far from avoiding the oil crisis that analysts were talking about at the start of the Iran war, we might just be in the middle of it? And what will be the impact?
Look, I think it really remains highly uncertain. Just no one knows, and everyone is doing all sorts of scenario planning on all the options that could play out from here. I think one thing is certain, that we're just not going to go back to the situation that we're in before this war broke out. There's a real risk that prices could shoot higher again if those alternative transit routes like the Suez Canal are blocked, or if there's really some sort of major damage to actual oil production infrastructure in the Middle East. We haven't really seen that yet, despite having seen ships blown up and missile strikes. We haven't really seen any major hits on global oil infrastructure that could take years and years to actually get remedied and, for the oil supply to go back to normal. It's hard to compare what's happening now, I think, to oil shocks in the past.
Mm-hmm.
There have been so many other ways of mitigating what's happened in the market and adapting that we just didn't have back in those 1970s oil crises. So we've just got a much more sophisticated market, an interconnected market now. We've been able to work around a lot of that. But I think in terms of the ongoing impact, we might just be at the start of this. I mean, who knows? As I was saying, no one is expecting things to go back to what they were in January and February. So it just looks as if we've got these extra costs and extra risks really baked into the market now. It's going to be interesting as to, how Australia decides to respond to all of this. I mean, do we really start to boost efforts in, for example, sustainable aviation fuel? Do we do renewable diesel? All sorts of those alternative fuels that we really haven't spent much effort on so far. That could really take off now.
The boss of the International Energy Agency came out to Australia in March, right in the midst of the crisis, and spoke at the National Press Club. He kept saying, this is a bigger oil shock than all the 70s shocks combined. But one of the points he made was that the International Energy Agency was actually established because of those crises, right? It was like, okay, well, in the event of this happening again, we need some coordinating body or some mechanism to absorb these shocks and have stocks so we can manage a crisis like this. So I think that partly explains why the world is somewhat better prepared to deal with this, even though the extent of the shock is actually larger in absolute terms. But even so, I think it's worth noting that this is probably what a major oil crisis actually looks like in the 21st century, and that's not to downplay it. It's just that it's going to be a kind of slow burn that's going to wash through the economy over time, and its effects will be incremental, but they will be significant, especially the inflationary effects. Everything's going to start costing more. And I guess one final broader point is there's been this lurch back towards economic sovereignty as a result of these global crises, doing things onshore. Crises like this one and the COVID pandemic and the global financial crisis. All of that is well and good, but it does add cost. And if we think about globalisation as a cost-lowering exercise, then it stands to reason that renationalisation will go in reverse. I think the things to watch in coming months will be these cost pressures.
Thanks, Ryan. Thanks, Angela.
Thanks, Lisa.
Thanks, Lisa.
Thank you for listening to The Fin. If you want to read more about the fuel crisis, check out the show notes. And don't forget, you can listen to all Financial Review podcasts on the AFR app. The Fin is produced by Mandy Coulin. Fiona Buffini is Head of Premium Content. Our theme is by Alex Gow. For more stories about markets, business and power, subscribe to the Financial Review at afr.com/subscribe. I'm Lisa Murray. See you next week.
The Australian Financial Review.